If you made over $150,000 last year and you're over 50, the IRS just changed how you're going to save for retirement. This video is going to tell you about the changes and about the things that you can do about them. Hi, my name's Sally Boyle, and I help retirees or people approaching retirement within 5 to 10 years retire into a lifestyle that they can't wait to wake up to. So here's what's happening. Your catch-up contributions, that extra $7,500 or $11,250 that you could save beyond your 401k limits, they must now go into Roth accounts. No more tax, no more pre-tax options. Now, here's the quick math. If you're in the 35% bracket and you're losing about a $3,000 annual tax deduction, and for somebody in the 37% bracket, they might be losing up to $4,000 in tax deductibility. Now, I know what you're thinking. Great. Here's another tax grab. But here's the strategic angle. This forces tax diversification, whether you want it to or not. Now, if your effective tax rate today is 35 to 37% and you're deferring into a 25% bracket in retirement, this may not feel great because normally pre-tax savings will win while you're working. But if tax rates rise, and with our national debt the way that it is, this forced Roth conversion could accidentally be the best thing that happened to your portfolio. Because what it is forcing is tax diversification. Roth assets don't count towards RMDs. And so if you need to, for those of us who will be taking our income at age 73, forced RMDs from our pre-tax accounts, this allows us to keep more in those accounts in the tax-deferred preferred way. But let's be real. You didn't really get to this income level by just accepting these kinds of new costs without some considerations. So here's a few moves that you can make to make up for this. First, make sure that you're maximizing your HSA. If you're 55 or older, you get a $1,000 catch-up contribution in your health savings account, 100% tax deductible. And that's the only account that has triple tax benefits: deductible upon contribution, deferred earnings while the monies are there, and then finally coming out tax-free if you use it for healthcare costs. It's a bonus. Second, most highly compensated executives have deferred compensation plans available to them, and you might be participating in one right now. So go to your HR department and talk about this, because the IRS has no limit on these non-qualified deferred comps. You can save $50,000, $100,000, which would easily replace the loss of the deductibility of these contributions. And third, if you're self-employed or you have a side business, you can implement a pension plan or a 401k, solo 401k if you're the only employee of the corporation, and save $32,500 to $275,000 annually, which more than makes up for the $4,000 loss of deductibility. And fourth, if your plans allow for after-tax contributions, you can do a Mega-Backdoor Roth. Again, this doesn't replace the tax deductibility of your catch-up contributions, but you could still pump in as much as $46,000 into your Roth account, which makes the amount that is in there more substantial. You're going to pay taxes on this anyway, so it's nice to get it into the account and take advantage of the tax-deferred nature on the earnings. And finally, for all of us, you can use tax loss harvesting if you have a taxable account. You just simply sell your investments that are in a loss position, and you can harvest up to $3,000 worth of losses that can be taken against your active income. When you put this together with your HSA catch-up, you really are making up for the $4,000 loss in deductibility anyway. Now, for S-corporate owners, be careful. I know I see some of my clients who say, well, I'll just keep my income below $149,000 to dodge this whole rule. But the IRS isn't stupid, and they will reclassify your if your compensation's too low, they'll reclassify your distributions as salary, disallow your contributions, and you'll pay taxes and penalties. So if you're close to that line, you have questions, do a reasonable compensation study and spend a little money on that, because it certainly is better than an IRS audit. So in summary, here's the things that you can do. First of all, calculate your exact the loss of deductibility and your exact tax impact. Those loss deductions times your marginal tax rate. And then call your benefits team to see if you do have after-tax savings for the Mega-Backdoor Roth, or can you enhance a deferred compensation contribution. And then do a Roth conversion analysis to see if you're going to be forced to save in a Roth anyway, maybe this tax diversification in retirement makes sense, and it would make sense for you to do some additional Roth conversions. And then finally, be sure that you're maximizing your HSA deductibility and you're looking for any sort of tax loss harvest that are available to you. Look, this change is coming one way or the other, whether we like it or not. So the executives who will win are the ones who will anticipate the changes and adapt to their saving strategies. Your friends might be doing it right now anyway. If you like this information, please drop us a comment below. Follow us for more information like this. And also, if you've got some tax saving strategies that you have really enjoyed, either in 2025 or you're thinking about doing in 2026, give us a comment about that below as well. We feature those sometimes in our future videos. And then finally, if you would like someone to model some of your considered changes, particularly Roth conversions, things like that, click the link below and schedule an analysis with us. We'd be happy to do it for you. Again, happy planning.